Okay, everyone. Sorry, I'm having some problems with my camera for some reason. So, see if I can get this working at all. I don't know what the heck is going on here, but hopefully I can get it started. But if not, no big deal. At least I'm here. So I got a brand new computer, and of course, a lot of growing pains with a brand new computer. And one of them is it doesn't seem to like my camera. There it goes. But again, as soon as it comes up, it freezes. So, oh well. Like I said, just not working. So I guess I got a face for radio today. All right, so let's get started anyway. And looks like the recording's on, so we are good. So good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to the Trading Coaches Playbook. And my name is Brandon Wendell. I'll be your host for about the next hour or so. No, I didn't get any hole-in-ones yesterday. Closest I got was about 4 feet on a par 3, and ended up getting the birdie, which is good. I don't mind that. But no, it was great to get out there and play a little bit yesterday. And it's a beautiful day again today in South Florida. Hopefully it's nice where you are. And well, we'll get started here, like I said, and kind of take a look, see what's going on. As far as, well, my topic for today is actually using sector rotation to help time the markets and help you with identifying opportunities there. I think I'm just returning message. So hopefully you can see my screen and hear my voice. I wish I could show you the camera, but for some reason, again, it's just not working. So, oh well. C'est la vie, right? Such is life. Yeah, you can see it's just frozen completely. Yeah, close it. All right. Anyway, before we get started, what I do have to say is we are not broker dealers or investment advisors. I'm not licensed, so I'm just giving my personal opinion on the markets, not giving any recommendations or personalized advice to anybody. And there's always risk involved in the markets. No matter what we do, we can never eliminate the risk. We are just going to be able to minimize it. And we are not subject to trading restrictions, so I can have a position in a security and initiate one at any time. So that being said, we're going to jump into our topic for today. Before I do, I just want to remind you that there's a lot of stuff going on. We do a lot of free online workshops. As a matter of fact, I got one coming up April 21st, E-minis to the max. And then, of course, every Monday, you've got the Power Hour, which is great. Oh, welcome, Lee. Thank you. And Amelia. And of course, welcome everyone. So Kevin, Helen, and everyone else here. I want to welcome you all. So make sure you join us for some of these free online workshops. You get a lot of good information. That's obviously probably the best price you'll get, free. And if you want to spend a little bit of money, you get a lot more for what you spend. And you see there's a lot of premium online workshops coming, as well as I also teach every Monday, Wednesday, and Thursdays from 9 a.m. to 11 a.m. I teach what's called the E-mini Think Tank. So if you're interested in joining me for that, we'll give you the link in order to join in if you're interested. And anyway, we'll talk a little bit more about how that works. You know, there's a lot of stuff that we do here. If I go to my login, I think, yeah, there it is. I've got all my access to my different programs. And the nice thing about the E-mini Think Tank is it's chock full of goodies. So when I click on that, you'll see I'm on my member area and there's a lot of bonus material. So what I do is I combine teaching with the online mentoring, where as a student, you can log in and there are recordings of the sessions we did, as well as bonus videos. And the bonus videos are educational. So it's like on-demand education if you want, and it's on-demand education if you don't want. So with each video, there's usually documentation that backs it up as well. So there's a lot of documents there that help you. We also track every trade. I start off the sessions with trading ideas. As a matter of fact, I can show you what one of those idea pages looks like. Let me just open it up real quick. And let's see, where's the last one? Oh, there we go. April 7th. Basically, what I do is every session I start off and give a few different trading ideas. I'll even share with you the ones I have going on right now. So I was looking at lean hogs, the 30-year bond, Japanese yen, and micro Bitcoin, looking for some trade opportunities. They're all happen to be shorts. And some of them work, some of them don't, but they're good trading educational ideas that I discuss. You know, I go over why we're doing the trades first, and then we trade them. You know, we look for the opportunity in a simulated mode just to get some practice here and see how it works. So I've been tracking these for a while, ever since I've started doing them. Let me see if I can find E-mini. Yeah, I'll go back to March. Just show you a completed month. Like I said, I track everything we do. So, yeah, Not afraid to show. We have winners and we have losers. And let me see, why can't I enlarge? It's hidden. There we are. As you can see, it goes back and forth. Main thing is we want to keep the losses small, even if we have quite a few of them. Some of these are no entry because we're strict with our rules. If they don't hit the entry point, we're not going to take the trade. We're not here to gamble. We're here to find great opportunities and speculate in the markets. So for the month, we were positive, and you can see you could have probably taken most of the trades, honestly, with a $15,000 account. Some of them are overnight trades. Some of them are intraday. It varies. And if you wanted to make sure you could take everything, obviously you can have a bigger account. If you were using real money, I'd recommend you start off with simulated, obviously, to practice these strategies first. And this was not the best of months. I actually was only right 56% of the time on the trades I took, but it was positive because I tried to keep the losses much smaller than the gains. And that's the key. We had almost equal number of gains and losses, but because the losses are smaller in size, they're easier to overcome. So I'm doing the mini think tank for about 3 years and haven't had a negative month yet. And I don't plan to. So, it's all about risk management. Anyway, let's get into what I was going to talk about today. This is just a chart of the S&P. I'm going to go bigger picture here and actually go to the S&P index on a weekly time frame. So the topic for today is sector rotation for market timing. And obviously, when we're looking at any market, we're trying to time those markets to figure out, okay, what should we be trading and which direction should we be trading in, right? So let's see, why is this not disappearing? That's weird. I'll figure it out later. Something's happening with my, I swear there's always got to be something going on, right? Let me escape that. Close this. And I'm not sure why my line is not disappearing. Oh, well, that's fine. So anyway, getting back to the charts, we want to time these markets. We want to know, for overall, if the markets are moving up, how long are they going to keep going up? Or if they're going to be moving to the downside, where and when is that going to occur? And obviously, the best thing to look at is usually price. Price itself will generally give you warning signs. And if you follow some of the education that I've been putting out, I actually have a new program that I'm doing now. So if you're interested, this is absolutely free. You can go to YouTube and do a search, see as it pops up, for the Wendell effect. So hopefully you've checked these out. If not, hopefully you will. So you go to the Wendell effect here, and you'll see I've actually only recorded 2. It's a brand new program that just started. Wow, pretty good. We got 3 days ago. I put it up and I've got 1,400 views already. But what it is a video that I'm going to be putting out every week, and has multiple sessions in it. I go over the charts, just broad market kind of analysis, bring up the schedule. There it is. And you can see I go over equity index futures, equities. I actually cover some Indian markets because I lived over there for a couple of years and still have a lot of friends that trade there. I go over cryptos, and I do chart school. So I go over a particular topic, kind of like what I'm going to be doing today. And that's a weekly thing that goes on. So you can see if you just type in the Wendell effect and do a search, you'll go ahead and find that. And it's absolutely free. So hopefully you'll join me once a week in watching that video. So there's a link for it as well. Anyway, getting back to our topic for today, as I was saying, we want to time these markets. We want to know when the market's going to change direction. And the reason why I brought that up is some of the education I cover both in the E-mini think tank, actually a lot of detail in the E-mini think tank, is the RSI. But I'll also be doing a little bit of that in the Wendell effect, just not as much in depth as I do in the think tank. As you can see under bonus videos, I have, where are you? There it is, relative strength index. And I have in my documents under fundamentals, RSI rules. And it says 2020 because that's when I published the last version of it, but it really doesn't change very often. I use the same rules unless there's a problem with those. We don't want to be changing our tactics all the time. Find something that works, stick with it. So if you want to learn more about that, obviously, again, in the videos, I also really reference it almost every week in the live class. And if you can't make the live class because it's 9 a.m. to 11 a.m., 3 days a week, they're all recorded. And some of the trades are swing trades, so you still get an opportunity to practice those trades. And this was a negative divergence, which is telling us the markets are weak and getting ready to drop. They actually did. And right now on the broad market, we're seeing a big topping tail. That was last week. This is this week. We're confirming the bearishness by making lower high and lower low. So this is suggesting the market, in this case, the S&P 500, is getting ready to drop once again, probably take us below 4,100, maybe even lower than 4,000. So we're seeing weakness. What we can also do to help confirm this is look at what's called sector rotation. And there's a couple different ways of doing sector rotation. I'm going to go out to a site called stockcharts.com. Now, I only use the free version of this because I do most of the charting myself. But to give you some basic information, when I became a chartered market technician, a CMT, I had to learn by reading a lot of different books. And one of the books I had to read was by John Murphy. He was one of the original technical analysts on CNBC. Actually, he was there when it was FNN, Financial News Network. So before it was even, again, CNBC, it was FNN. So anyway, oops, sorry, got distracted here for a second. We're good. So I go to the site that's run by him, or at least they use his teachings, and I go to the free charts and tools, and a little below here, you see it says performance charts, and there's some predefined groups. The one I'm going to look at is sector ETFs. And there we are. So actually what I can also do probably is just copy this and paste it into the chat for you. Now, there's a book by Sam Stovall that was out many, many years ago. You can see right here, based on Sam Stovall's Guide to Sector Rotation. That's, I think, a $200 book. Not positive, but I'm sure it's pretty expensive if I recall. Actually, you can look at it here. And the book's not even available, out of print. But yeah, if you find a copy, I've never personally read it, but it's supposedly pretty good, and it's been around for years, obviously. So you don't need to buy the book. Okay. Basically, it's about sector rotation. There's other books you can read on sector rotation that will give you the same information. As a matter of fact, John Murphy himself actually wrote a book on ETFs and sector rotation as well. So anyway, the reason why I bring this up is in the orange, you have the stock market rotation. You see it goes from market bottom, bull market, market top, bear market. Usually that stock market is going to lead the economy. The economy is in blue: full recession, early recovery, full recovery, early recession. And the stock market generally leads the economy by about 3 to 6 months. Makes sense when you think about it, because we are trying to invest on what we believe the economy is going to do in the future. So by looking at these sectors, whichever sector is best performing, that can give you some sort of a clue as to where you are in the overall movement of the stock market. So when the market's at a bottom and we're in full recession, people are starting to look forward to us coming out of said recession. And therefore, you're going to see some speculation in the discretionary securities that don't do well when the markets are crashing, but are usually pretty cheap before they start rallying. So you get technology and discretionary becoming the hot sectors, if you will, before we start to rally off the bottoms. Then we go into consumer services, industrials, and materials. Well, industrials and materials are good when the economy is starting to go back up because there's huge demand for all that. Eventually, we get inflationary pressures at the peak of the market when everything's running really hot, the economy's doing well, there's a lot of demand. So naturally, inflation becomes an issue. And therefore, the energy markets start becoming the best performer. Well, when there's a possible top of the market being put in, there's going to be what's called a flight to safety. So people will run to the sectors where they see that their money is going to be relatively safe because they're defensive plays. And when we start looking at the defensive plays, we see consumer staples, number one. Those are materials and products that people always use no matter what's going on in the market. You know, we always use toilet paper, hopefully. We brush our teeth. So you got some staples, which are things that, even paper in general, we always use that kind of stuff. So things that are defensive, we'll always consistently use them no matter what's going on in the economy. Healthcare also rises. If people are laid off, they're actually going to use their healthcare and their COBRA before they lose everything. And then utilities, which are interest rate sensitive, start performing well near the bottom of the stock market or even on the way down. And the reason why utilities are interest rate sensitive. When the economy is starting to dive and people are worried about recession, you're going to see the Federal Reserve start to cut interest rates. So any securities that react to interest rates are going to start performing better. So that's why you're seeing the utilities get a boost then. And eventually the financials and real estate, they also benefit from low interest rates. So that's near the bottom of the stock market. Unfortunately, I have a picture somewhere. I got to find it, but I can't go back to 2008 when the market crashed. It only allows me to go back so far here. So if I go back to the beginning of 2008, maybe we get a little picture of it. Not quite. Before the market crashed, the top of the market was October 13th of 2007. And if you look back then, industrials, materials, and energy were the hottest sectors. And then you could see the crash of the market. Oh, I can just go from the beginning. Oh, actually where it was. And the whole bear market ran until about 2009 in March. And you could see, what's too far. There's the best performing sectors: staples, healthcare, utilities. For some reason, real estate was doing really well then too, near the bottom. But during that kind of the meat of that bearish market right there, look at that. Consumer staples are hot because people are flying into safety. By the way, this is how they performed against the S&P. Okay, don't think you would have made money by buying those, because that's how the S&P, that's how the markets actually did when you take out the S&P. Okay, so don't get confused there. It doesn't mean, oh, I better buy staples. Well, no, they'll still drop. They just won't drop as fast. So you're better off shorting the markets and looking for opportunities on the downside. Now I use this because, I was talking about how I teach futures. We teach and trade in the futures equity index futures. So this is going to be beneficial for that. It'll also be beneficial for commodity futures to help time the rotation of that as well. So it can really be, this timing can be useful for almost any security you want to trade. I mentioned I'm trading in the E-mini think tank futures, E-minis. And if I go here, let me show you. There it is. This little page right here. See if I can paste this link for you. Yep, there it is. So if you go to that page, mrci.com/special/correl.htm, you come to this, which is showing you basically, oops, wrong page, the correlations between different securities. And it defaults to 180 trading days. Okay, you see right here, it says 180 trading days as of yesterday's close. So I was saying that sector rotation obviously is going to impact the equity markets. Well, right here we have the Dow, the S&P, the NASDAQ. But if you're trading something like crude oil, we can actually take a look to see, not on my screen yet, so we go further over. And right at this point, crude oil and the S&P, they're actually moving in opposite directions. Okay, so often they can move together, sometimes they move opposite. But if the sector rotation is influencing the stock market, you can better believe it's going to affect the crude oil market. You can take this all the way out and actually see how it affects lumber. It doesn't look like it affected much because there's not a whole lot of positive correlation. Feeder cattle, though, has a bit of correlation. So does live cattle. So you can actually use a sector rotation for pretty much any security. You just got to understand how it's going to impact the broad equity market, and therefore what is the relationship between your commodity and the equity markets. Now for the sector rotation, when I'm looking at this, I typically want to go back about 6 months on average. So if I right click, I can do past 6 months and it shows me what's going on right now. So what is happening if we look at this right now? Well, we have energy is the best performer, but we're also seeing a lot of buying in staples, healthcare, and utilities. This is against the S&P 500 once again. Wait, maybe it's not. That was the sectors by themselves. This is against the S&P. But overall, we are seeing that we are here right? If energy is the best performer, we're also seeing a lot of buying in consumer staples, healthcare, and utilities. What does that mean? Well, we're getting ready to take a ride to the downside, doesn't it? So when you're looking at the sector rotation, a great question came up is, what time frame do I suggest for this? You are looking at big picture. That means you're using weekly or even daily, maybe even monthly if you go that high if you want to, but you're not looking at a small time frame whatsoever. This is definitely a much larger time frame, weekly or daily. Okay, so this is not used for exact timing. It's to give you an idea of what to expect. And this is telling us that the market, which has been going up and up and up for quite some time, if you look back, may be at its peak and getting ready to come back down. And that's exactly what we're seeing. Notice we made high, low, lower high was just put in. This is a weekly chart of the S&P. And you can see, oops, wrong one. That's where it's suggesting that we are right now. Oh, okay. So John C is saying there's also another one for good sector rotation. Great. I'm always open to suggestions. Let's take a look. And let's see. Select sector spider ETFs. Yeah, again, it's showing the XLs. Those are the different sectors, XLE, XLU, XLK, and blah, 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 so on and so forth. So it can tell you sector tracker, again, same thing, energy. Now, I don't know if this is just a daily or what, yeah, it's today's performance only. Obviously, I want to look at it further back. And by digging into this, I'm sure on the website, you probably can go back and, take a look at 6 months or so. Correlation tracker, I'm curious. You got me going down a rabbit hole. Anyway, so yeah, there we go. I can take a look at a time and compare different securities over different times. So it looks like, yeah, this is the actual SPDRS. This is probably from the company that created these. So you just create a free account and that way they can market stuff to you, but then you can actually use some other tools. So that's pretty nice. Yes, I like this. So thank you for bringing that to my attention. I was add in a bookmark there. Yeah, it's fine. Cool. But again, I can also do this individually. The main thing is you got to remember what all these are. You got XLE, XLU, XLK, XLB, and so on, and then XLRE for real estate. So those are the main sectors. Now, what we can also do is create our own charts to get an idea of where the market is as a whole. And one of the things that we can do, we go back to where I was right here, is compare these different sectors against each other. So overall, bear with me a moment. Just take care of something here. There we go. Anyway, overall, you can see that technology, and actually more importantly, discretionary, consumer discretionary sector is the sector that does well when the market is very, very good and people have extra money. These are products that people buy that are not necessary, but it's what we want, luxury items. Okay, those are discretionary items because you don't need those things, but you buy them when you have extra cash and you want to, splurge or spoil yourself. Consumer staples, I already mentioned, those are things that we need to buy on a regular basis for, our comfort and survival. So what if we were to compare those two against each other? Well, I happen to use TradingView. Okay, and you can use a lot of different programs out there if you want. If you're interested in TradingView, let me see here. I'll give you a referral code as well if you want. Here we are. That'll give you a $30 coupon for it. But, if you want to use the free version of it, use the free version. If you got software that does this for you already, then just use that. You don't necessarily need to pay for the extra software. But I like TradingView. I can hook it up to my trading account and use it for a lot of things. Anyway, what I'm going to do is create a simple chart. I'm going to take XLY. Okay, so when I go to stock, it should show that that is consumer discretionary. And I'm going to divide it by XLP, which is consumer staples. Okay, so the chart we are looking at now is the price of the XLY divided by the XLP. That's it. Okay, this is XLY, which is consumer discretionary. And divided by XLP, which is consumer staples. Okay. And that's all I'm doing here is I'm dividing one by the other. And you can see there's the price, 2.3, or the ratio, basically, that's what it is. Now, why would I care about this? Well, the reason why I care, actually, I can leave that there too. The reason why I care is if the consumer discretionary is doing better than consumer staples, you would expect that the stock market is going up, right? Because going back to that rotation area, an idea, the discretionary does well when people are expecting the markets to go up. And if they're expecting the markets to go down, they're going to be buying the staples. We're basically looking at the sector that is just before the change in price. And you could probably use some others. We can probably compare healthcare, which is a little further down, against technology or consumer services. Oh, no, it's communication services. So you can compare others, but this is kind of the most extreme, one against the other. And that's what all I'm doing is I'm comparing one against the other. So if I were to bring in, just show you the S&P 500 index, when you take a look at these two, it's doing it by percent change, which is fine, but you can see they move pretty similar to each other. So when that consumer discretionary is moving up, overall, the stock market's probably moving up. And when the discretionary is moving down, then the stock market's probably moving down because people are running to safety. Could you use this for spread trades? Well, in this case, it would actually be called a pairs trade. But yes, a pairs trade is when you would buy one security and sell another, try and take advantage of the price difference between the two. So a spread trade is when you do it on futures, and a pairs trade is when you do it on stocks. So, but yes, you could do that. Now I'm just using it as a tool for timing the markets. Let me show you how that works. And what I'm going to do here is just change this to 2 charts. And I'm going to clean this up. There we go. Actually remove all. I'm going to put in SPX on the bottom. There we go. Go to that weekly. Heck, let's start off monthly. Do big picture here. Okay. And I'll do monthly on the top as well. There we go. So on the bottom, we've got the stock market. On the top, we've got that consumer discretionary versus consumer staples. And we can take this back into the late 90s, early 2000s when the ETFs first came about. And we can see, can we use this as some sort of a timing for these markets? Whoops, went too far. So back in the 90s here, you can see, and this is on a monthly chart. So we're looking at a really big picture. And overall, the trend, as you can see, was very, very bullish. You see settings, extend to the right. There you go. So you can see that we were actually accelerating even more. I'm trying to get a good trend line. In order to have an official trend line, you need 3 touches. And I really don't have that. All I see is that we got 2 touches and we accelerated a little more on that. But what basically happened here is on this month, which is May of 2000, you can see we broke down, didn't we? As a matter of fact, right here, we had a candlestick formation at the top. This candlestick formation is a bearish harami. Okay, so you've got the big candle, that's the mother, and inside the belly of the mother, the body is the baby. And there's the confirmation as we break lower. So that's a bearish harami, which, by the way, is an interesting concept when you think about it, depending on the languages you know. Basically, when we talk about candlesticks, they're Japanese candlesticks. And in Japanese, harami means pregnant, because you can see the baby is in the body of the mother. But be careful where you use that word, because if you say it in India, in Hindi, harami means bastard. So it's a little different. And in Arabic, it actually means, loosely translated, means thief, and it's a very derogatory term to call someone. So you got to be careful when you're teaching trading, how and where you teach it. You got to understand these terms. Anyway, overall, that's a bearish signal for the markets. And that happened in May of 2000. So we go to May of 2000. Where are we here? There we are, May of 2000. And on the monthly basis, we got a warning sign that this market is fleeing to safety. So what happened in the stock market shortly after? See the drop. That was the crash for the tech bubble. So it was a pretty good timely notice, wasn't it? It told us that the markets were getting weak and we were likely to keep going to the downside rather than up. And then we bottomed out here in, it looks like 2000, kind of changed the trend. Okay. Unfortunately, I can't change that to so you can see everybody's comments. It doesn't allow me to do that the way I have everything set up. So you just see my comments. And what I can do is if there are comments coming in, I can read them off to everybody. So I apologize. Yeah, that's just the way it's set up. So anyway, you can see that was a signal for a market change. Then as we were moving to the downside here, let's see if we got any more of a trend that develops. Kind of, but you can see right there in January of 2001, we got the signal saying, hey, you know what? We've been moving down. It looks like things are going to be okay. We're going to turn back to the upside. So in, what was this, January 2001, well, we weren't done moving down, obviously. So it was a little bit of a fake out there, but it was saying that things might get better. Again, you can't just go blindly by this and say, okay, it's all turning around, because the markets continue to drop until 2003. And you can see that we really didn't make we started to make a little bit of a bullish trend. Actually, let's break this down a little more, because you can see we tried to go up and then broke down yet again here in August of 2001. So if you look from January of 01, whoops, wrong one. Come on. January 2001. There we go. That's what I wanted. Until August of 2001. Prices were moving down, but not nearly as fast as they had afterwards. You can see that we started breaking down again. So we had an acceleration to the downside. So it's not perfect, but it can give you an idea of which way markets might be going. So when we identify a nice trend that breaks, that could be a warning sign that your trend on the market is going to change as well. That's all. So again, we're moving up, moving up, moving up. Everything looks pretty good. There's a small pullback, and I'm looking at a monthly time frame, not a small time frame here. It's pretty big. And right there, we got a big warning sign in 2006. At this point, you can see we've been hitting this low over and over and over again, and we finally broke that low in July of 2006. So moving to July of 2006. Oh, there it is. Didn't mean to do that. There's the breakdown. And you can see that this is warning us that this move to the upside is probably not going to keep lasting. Oh, nope, there's a little false breakout. We're okay. Still going back up. It's easier when I go to a weekly chart to see more detail. So if I go down to the weekly chart, let's do that. Here we are. And again, I'm going to go back in time a little bit. I don't need to go over every little turn in the markets, but I'll just stay right here. In 2013, let me clean up my chart again. Now I'm on the weekly chart. And again, same thing here. I need to bring this back. So in 2013, overall trend, let me just make sure, February 2013, there we are, was upwards and a little bit choppy, but not too bad. And you can see we're still moving up. We've got a nice uptrend. And now let's see. Nope, we still got an uptrend. There it breaks down. That's going to be March of 2014. So in March of 2014, here we are. We have a warning sign that things may turn down pretty soon. Okay. And let's see if this continues or turns around on us. Nope, that continued down for quite a while here. So we had that dip down until, am I on a daily? No, I am on a weekly. March, April, May. There we go. March. This didn't really do much. Just went sideways in this time. Let me zoom in a little more so I can see it better. But there you go. March, April, May. You can see we pretty much went sideways and could not really accelerate upwards until right there, May of 2014, we finally broke that downtrend. So if you were an investor and you saw this happening, that's a warning sign that things may start to get a little bit weak in your equity markets. And as you can see, as an investor, we really didn't make any money there. We were going sideways. Now, it didn't drop, fortunately. And again, you got to combine this with other analysis. You cannot just automatically assume just because this breaks, it's going to change. You want to take a look at the big picture, maybe the whole sector rotation, not just the two securities. But I've been using this for an overall view of what's going on in the market. So there we're bullish again. Actually had another breakdown right here. Once more, you can see we came off those lows and we're moving very strongly to the upside until September of 2014. We got a breakdown again. So we go to September of 2014. Here's your breakdown. And there's your dip in the markets. Look at that. So again, not perfect, but a pretty good warning sign. This was September 2nd. There you go, September 2nd. The actual breakdown didn't occur until a couple of weeks later. But it warned you there was a big problem with the momentum in the market and that we were likely to move down. And sure enough, we did. So how do I know when the danger is done? Wait for the trend to change. Overall, we have a bit of a downward trend here. Still not out of the woods yet. Now it looks like it's trying to break to the upside. That's going to be November of 2014. And it happened a little bit late for the warning sign. Probably could have saw it here. We started getting green to the upside in October. Sure enough, that's where things started moving up. So again, let me clean this up, continue forward. Became very bullish. And we got some weakness coming in, nothing major, not really a change in trend by any means. Just kind of going sideways and floating a little bit in 2015. And that's where we had some weakness in price as well in 2015. Notice we're moving sideways on price. We move sideways and down on that indicator as well. Now we got a problem. We rallied up and really started selling off. And this is in November of 2015. So going to late 2015, you can see we took a dip here early in 2015. That was back here. That moved down, correlated with this. But this is a big warning sign in late 2015. We haven't gotten there yet. Here it is. So we should be getting a dip in price. And there it is. Look at that. We got that warning sign on the 23rd of November that things were going to get more bearish. And there it is, 23rd of November. We actually dropped about a month later and had a big drop in the market. And that's a good warning sign. If you're an investor and you see that dip like that, that's telling you that, hey, you need to book your profits. You may need to go defensive in your markets. So if we take it out to where we are right now, let's see what's happening. Overall, we're bearish. Now, when did this bearishness begin? Well, let's take a look. A little more detail here on the weekly chart. I really don't want to go much lower than weekly. So before we got bearish, we actually had a break to the upside. As you can see here, October 11th of last year, we broke out of our sideways motion to the upside. So that was telling us there was a good opportunity for going long. However, as soon as we did that, we started seeing choppiness and weakness here. And more specifically, again, I teach a lot about the RSI in my E-mini think tank classes. This is what's called a negative divergence. Prices were moving higher, as you can see, on a weekly basis, 1, 2, 3, 4 weeks, and we go to a much higher high. But on the indicator, we have a much lower high. That's indicating there's a lot less momentum in the markets, and that's not sustainable. So if you're seeing that the momentum is not sustainable, that means there's likely to be a turn in price coming very soon. And sure enough, a couple of weeks later, there's your breakdown in December of 2021. And from that time forward, we've been pretty bearish, haven't we? So first of all, October of 2021, we got a bullish signal. So I go back to my broad market, pull this forward, enlarge, go back, October 2021, right there. So back here, once again, we are being told it's time to buy. We've broken out of this range. There's a lot of bullish momentum on the consumer discretionaries. So in your retirement funds, you'd be looking at piling in on things that are going to move up when the markets move up. And it paid off, started going up. The warning sign then, divergence here in December, and the actual breakdown in December. So I go forward on the stock market, beginning of December, there it is. That's telling you to get out of your longs, book your profits, and go defensive because we're getting ready to drop. And if you listen to that, at first you're thinking, no, Brandon, why did I listen to you? I'm missing out on opportunities, right? Well, again, you can't time it exactly just with one thing, but there we go. And the market's dropped. See, the markets love to warn you and tell you when it's going to turn direction. You just got to know how to listen for it. You got to be able to read the messages. And this one's pretty good. It's not 100% accurate, but it is something that works very, very well over longer periods of time. So once again, we had that move down. Now we need to know, when is this bearishness over? When's it time to buy? Well, if we start to establish a bit of a trend here, let's see. Kind of accelerate a little bit. Still bearish there. Oh, looks like we broke that trend now, March 14th, 2022. So that means if you've been waiting to get back into the markets, or if you were defensive, stop being defensive, look to buy now because the stock market's getting ready to rally. Again, going to March 14th, here it is. Was that a good time to buy? Looks like we rallied, didn't we? But it didn't last. It was a very quick move to the upside, and overall, the bearishness in the markets is still extremely strong. Just connecting these two green candles, you can see we broke down on the 28th of March coming into this month. And there it is, 28th of March. What do you see on the candles? That candle has got a topping tail. Okay. Now I mentioned, let's see, where's it here? I closed it out. In my YouTube video that I did on the Wendell effect, one of the things I'm teaching right now is how to read price properly. And I'll give you a little teaser on it. Basically, if you want to read price properly, there are four main things you need to be able to read: color, shape, size, and location. So again, in the Wendell effect podcast or vlog or whatever you want to call it, I'm actually going over this in much more detail. And this is free. So go to YouTube, type in, like I said, the Wendell effect on YouTube, and you'll find it. There you go. So you just do a search. Anyway, shape. When we take a look at these broad markets and trying to figure out which way are we going here, actually, I'm on the wrong one here. I'm going to go down to this chart right here. Shape is really just looking at where are you closing in relationship to the high and low. So specifically that green candle, you can see we opened at the bottom of the body. We tried to make a low, we couldn't hold it, and the buyers pushed us higher, but we didn't have enough buying pressure to sustain that. And by the time we closed, the sellers took over and pushed us down. Any price action you get between the high and the close is selling pressure because the sellers pushed prices downward. So you can almost imagine what's coming next based on what you're seeing in the price action. Okay. Case in point, let's pull this back a little bit. For instance, well, even here. Okay. This red candle closed near the bottom. Therefore, you're pretty much not seeing any buying pressure. It's all selling pressure. Next candle moved down, made a new low. This candle, however, closed near the high, which means all the price action from the low to the high is buying pressure. There's a lot of buying pressure and almost no selling pressure. Next candle should probably go up. There it did. However, when we went up, as you can see, we closed away from that high, meaning there's a lot of selling pressure inside this candle. Next candle should be moving a bit down. And it did. It made a new low. It's got a lot more selling pressure now because from the high to the low, or sorry, high to the close, that selling pressure, we only had a little bit of buying pressure on that low to the close. So we made another low. Okay, we're still moving down, but notice there's a subtle change going on here. That wick on the bottom is pretty small. The wick here grew a little bit. That means we have a little more buying pressure coming in. We're not as bearish as we were before. Doesn't mean it's time to buy yet, but just a warning sign we may not be moving down as much. So we did make another new low, And now we're getting nothing but buying pressure, right? Close near the high of the candle. That's all buying pressure. And we made another high. But as soon as we made that high, we got some indecision. So we're kind of sideways, a little bit more bearish pressure. And there's a new low. Now let me clean this up. You can see we actually made about the same low. I would have expected this to go down a little bit more. And by the way, it's not perfect. You can't just say, oh, shape, and that's all I'm going to follow. You got to use everything together, color and or shape and or size and or location. Okay. So that's tons of bullish pressure. We're more likely to move up. There we go. We moved up. Tons of bullish pressure, more likely to move up. And we did. But now we're hit with tons of selling pressure. So all that buying pressure that we saw once before is getting ready to give up. And it makes a lot of sense. Here's why. We're back into the start of all that selling pressure we had once before. So it's not really a surprise that we're losing momentum because look at all the selling pressure we had here. As a matter of fact, we have tons of selling pressure still left between here and here because we never got there. So now we've gotten into that selling pressure and it's pushing us down. Because this has a big topping tail, that means we have a lot of selling pressure. So the next candle is likely to move down, not up. And there it is. We moved a bit down. Currently, we're closing near the center of that candle, which is indecision. So we're not really ready to collapse yet. And our next candle is likely to be sideways or down, but probably will not be able to make a new high. And we'll find out next week, because that's the end. But overall, what the market is currently telling us, as I said, is that we tried to rally and gave up almost immediately here. As you can see, the trend broke back to the downside. You can even use other analysis on this. When we take a look at what's going on, we had an impulse to the downside. We've had a correction back up. Okay, so we impulsed down, corrected back up. Oops, come on. You can see we retraced 38.2%, worked Fibonacci. Okay, not only was it a Fibonacci area, but you can see that was the origin of that selling pressure as well. And we are likely to continue our march to the downside. So if we're trying to, we can see a pullback, it's continuing to go down. That means that the stock market's likely to continue to go down. If we want to know where our target is and when the momentum to the downside might subside, we can actually use some other tools like Fibonacci extensions or even look for zones as well. So we had impulse down, correction up. We're now impulsing back down again. And there's our targets. So not only can we look at the targets there, but we can also look back to see, are there areas of demand that are likely to hold us up on this ratio? Now, it won't work as well as demand or supply on the actual securities themselves, because this is not really reading any kind of institutional buying pressure. It's just looking at price movements. But overall, it does have a good zone here. There's one zone, rally-based rally right there that broke out the high. So that's your first target. And you can see there's a Fibonacci extension in the same area. That's where we're likely headed right now on this move down. As we come down to that area, if we end up breaking trend like we did here, then we could get a bounce in the price of the stock market as well. Does it make sense? Kind of combining a lot of different things together, but basically just using this to get an idea of where markets are likely to go in the future. Just try to get this all. I don't know why that will not disappear here. Yeah, it's beside the taskbar, but it's not doing it. Well, I'll figure this out later. All kinds of problems with the computer. But anyway, like I said, what we're looking at right now is the overall market is very bearish. We're getting a flight to safety, and therefore we're probably going to see that the stock market will continue to move to the downside. Well, looking at the broad market, it's exactly what we saw there, that indecision, and we start getting new lows. So does anybody have any questions so far? Make sure you're all still with me here. So quiet. Good stuff, very illuminative. Oh, thank you. Appreciate that. Glad you're enjoying it. Okay, good stuff. Well, thank you. Hey, if you like this, you should see what I do in the E-mini think tank. Like I said, I've got a lot more than just that. Plus, the nice thing about the E-mini think tank is the bonus sessions I do with education are all recorded. So you can go back and watch as many times as you want. So that way, if you got any questions on it, the other thing you can do is, again, review, obviously, as many times until it sinks in. In addition, when you're a member of the E-mini think tank, if you go to the bottom of the member page, you can send me a message. And that comes directly to me so I can get back to you as quickly as possible. So, I mean, here, I know this stuff, but part of what I love to do is teach and share my knowledge. It's a lot of fun. It's very rewarding, honestly. My mother is a retired school teacher. I always joke, I say I'm genetically engineered to do this because my mother's a retired school teacher. My father is a retired stockbroker. So obviously, if you blend the genes of a teacher and a broker together, this is what you're going to get. But it's really fun for me to be interactive, and I love training in groups, being able to share ideas with other people. It's just a fun thing. So hopefully you end up joining me in the E-mini think tank so you can get a chance to, trade with us in a group and just share ideas. It's really, really fun. And, like I said, not only can it be fun, but it can actually be enlightening and possibly profitable depending on how you end up treating this. So I don't think I've updated my April so far. I've got some of the trades in there, but I haven't updated everything yet. No, we had a couple wins, but again, there's a couple losses I just haven't updated yet. So we'll get there. Oh, thank you, Dory. Appreciate it. Stephen, thank you, everyone. So just give me an idea of how things have been in the past. Let me see, where was I? Move this out of the way. Oh yeah, the Traders Summit in California. I'll be there too. Yep, that's going to be in May. So I've been pretty busy. I'm also looking at doing something in New York for you East Coasters with wealth builders. I'm going to do a live session in New York. So Rob and I are working on that to figure out the exact dates. And I might even do it online as well as live in person. So you got the chance for those of you who can't make the trip to be able to catch the information there as well. But anyway, where was I going here? I was looking for, there we go. E-mini think tank tracking. I was trying to show you some other months besides the other ones we just talked about. There we go, February 2022, because I just showed you March. Meet up in Asheville this fall. Believe me, I'd love to. I love Asheville. But as I was saying here, we're pretty consistent. This was February. And again, February is a little off as well, but still positive for the month. Once again, the size of the loss needs to be smaller than the size of the win. So there it's about 2 to 1. I want to get better than that. I'm trying to keep it around 3 to 1, but I was a little off in the month of February, but still positive, like I said, for the month. The main thing is we're also gaining a lot of knowledge as we go through these markets, which is kind of fun. But getting back to our core thing, as I was saying, we can even break this down perhaps from weekly to daily and see how it works there. So if we're really trying to fine tune entries in the markets, let's see how this would have worked on a daily basis, right? So once again, I'm looking at this comparison chart between these markets, and I'll just pull it back slightly here. Thank you, Amelia. Yeah, if you're interested in joining me for the E-mini think tank and gaining access to all that education and more, there's the link that Amelia just put out for everybody. Let's see, the future see more in depth going to numerous websites. Seems like a lot of places to make mistakes. No, you're making it more complicated than it really needs to be. This technique that I'm showing you is an overview type of technique that you can use just to get an idea when the markets might be making major shifts. Okay, there's a lot of information on a lot of different sites, and I try to consolidate it as much as possible. And as I was saying, in the members section, I pretty much put out the documents you need for trading. So when I go here, you got bonus videos. Like I said, also what I did to try to make it even simpler was, I think it's here under fundamentals. Yep. What is here? And when you click on that, it'll download a document. I'll just save my downloads here. That's fine. And it's going to show me what videos and what documents are available on that site and what I should be doing when it comes to viewing them. Where should I be starting? So it says, start with the basics, then you got odds enhancements, then you got trading strategies. So when anybody comes to me and they're relatively new, they're not going to be lost. I want to make sure you have an idea of where you're supposed to be starting and how are you supposed to be using this information. So right here, start with the basics. and I say, okay, you got the video, trading routines and finding zones. And I even have the documentation that follows it. So you really have kind of a step-by-step instruction list as to what you're supposed to be doing here. And I wanted to make this very self-contained. Yes, there's a lot of outside websites that you can use. No, they're not completely necessary. You can trade, but with just the information that I provide here. Because I'm giving you literally, how to find right there, my pre-training routine. What do I do step by step before I pull the trigger on anything for the day? So I try to make it as easy to digest as possible. And like I said, I put together that document, as you saw, that's kind of shows you exactly what you're looking at and what to use and when. So again, going back to this topic that I was talking about today for this year, you can see that even on the daily basis, it wasn't really a warning sign for reversal there. This is kind of interesting. This was telling us that even though we had a little bounce going on right now, again, if you know the RSI the way I do and the way I teach it, this was telling you that even though we're bouncing, we're not changing direction because this is still extremely bearish. We have too much bearish momentum. So we're not changing trend direction. We're just getting a correction, meaning a pullback. So there's the pullback. And even though it might have broken a little bit of the trend line here, it's telling you, no, do not buy because this is just a small correction before we continue lower. And sure enough, it went lower. And there we are, still going lower. So here we are in January 2022, and the trend is still extremely strong to the downside, meaning that you should be looking for safe havens or shorting, right? And the trend is still down. Here we are testing the trend, and it's holding. Now, late February, got a bit of a question going on here. Are we going to break the trend? Should we now look to buy because we don't want to miss out in our retirement accounts if markets are going to go up? Well, looking at what's going on down here, this is telling you that yes, it is going to rally. And the reason why is prices are pretty much making the same lows, but the main thing is the momentum is doing what we call divergence, making higher lows. So that's telling us even before this broke that it was going to break and we're going to get a bit of a rally here in the stock market. And this is in mid-February. Okay. Still holding on. It's not really rallying strong yet. And it continued down. It wasn't the best of moves. As you can see, we couldn't get above 650. So even though the stock market may have stopped dropping, we go back to February here. Here we are. And there's the stock market. So early February was saying, end of January, early February, we're going to stop moving down. Notice we have a low, higher low in price. So we're not moving down as much as we were before. So trying to go for the safe haven is not as smart, but it's not telling you to buy yet either. So it's still moving down a little more at this point. We'll get to March here. Here's the beginning of March coming up. That's the last of February 28th. So I go back to the indicator to see what's going on. Again, it's just the one XLP discretionary divided by the XLP staples. And where are we here? End of February 25th. Here we go. Beginning of March. What's happening? We're at a crossroads. Let me show you. The crossroads is, you can see there was kind of a range we were stuck in right through here. And we're almost coming to that range to see if we're going to bounce down or break through. Okay. Prices diverge. So it's suggesting it's going to go up. We tried to make a new low in price, but the indicator did not have enough momentum to keep going down. That's suggesting that we're going to go up in price. It's not doing it yet because we don't have enough momentum to break out of that area. You can see that here too. So here we are again, retesting the prior lows. And now we have a bit of momentum to the downside. So it's still not telling us to buy yet. We're kind of waiting to see what the market tells us and where it's telling us to go. So another positive divergence right here confirmed we're going up. Prices made the lower low. The indicator did not. So March 7th, March 8th, it's telling us we're going to head back up, once again, we're not really out of the woods yet. We're probably going to come back up to this area and stall out once again, unless we get more momentum. So if you were a trader looking at the broad market, again, in late February or mid-March, you're still seeing sideways motion. There's no reason to go long or buy anything yet. It's just not telling you to. Now things are changing. Right here, towards the end of March, March 18th, we're going right back into this range. Here's the problem though. We're not getting above 60. In order to get bullish, look at this whole move down. From right back here in December of last year, do you see that RSI? That's what that indicator is, by the way, relative strength index is one I use very heavily. Do you ever see it going above 60 in the entire move down? Not once, right? The only time it goes above 60 is when you're in a bullish trend. Right here, we gave up that bullish trend and never went back above 60. So we're watching that right now. And if we can get above 60, that means the bulls return. If it doesn't go above 60, then it's a fake out and you don't want to get caught on the wrong side of the markets. Look at that, still going higher and we're not getting above 60, are we? So what does that mean? That means that this is a false move to the upside. We're more likely to move back down again very soon. Oh, until it can break 60. There it goes, finally. And that's on March 28th. So that we go back to the stock market. And where's the 28th? Again, it's much better on the weekly and higher time frames, but here we are. See, you might have missed out on a little bit of that rally right there. It did warn you that we were going to go up. It just didn't say we were going to go up very far because we're seeing a lack of momentum. But that divergence warned you right there. As soon as it confirmed on the 9th of March. Where's the 9th of March? That was a really nice confirmation right there, wasn't it? Positive divergence confirmed 9th of March. That's telling you we're going to go up. But it's just going to be a small move up. And that's exactly what happened. So now we're finally in bullish territory. So we're likely to continue to gain. There it is, 28th of March. Let's see what happens. Breaking down again. So from the 9th of March, you were told to buy right there. However, 1, 2, 3 touches right here, March 30th, basically 31st, really. Now you're being told if you bought, get out. That's pretty good timing. Where's 31st? There it is, 30th, 31st. That breakdown right there and a close below means on the open of the 31st, you need to be out of the market on the daily basis because we're getting ready to head back down again. And so far for April, it's been working. Moving down. So that's one way that I can use sector rotation. Really, this is what I focus on. I don't normally do it too much on the daily. I usually use it on the weekly, but if you're trying to fine tune entries and exits, as you can see, that positive divergence was confirmed on the open of this candle on the March 9th. You could have been going long. It was sort of a little pullback, but overall the prices rallied quite a bit by 300, almost 400 points to the upside there. So as of right now, we're still moving down. I want to see this go below 40. We're not quite there yet. We're at 40.10. But if we go below 40, then the bearish trend is going to continue down, and we should see prices move down, maybe even break that 4,200 on the S&P. But if we bounce here, and you can see that the candles are getting a little slower, we're not getting as much selling pressure. As a matter of fact, there's buying pressure. So if this holds above 40, then we'll actually continue to go to the upside. So as of right now, we're in bearish mode in the markets, but we may be coming to the end of that downward trend. We're waiting to see what happens. If we end up getting some closes and this chart goes below 40, then look out below. That's going to drop very quickly. So hopefully I shed a little bit of light on how to use the sector rotation. Again, if you follow me on the Wendell effect, you'll see a little bit more education there. If you follow me in the E-mini think tank, you get a lot more education because that's where I give all this stuff, all those goodies, and we get to practice this on a regular basis. So I hope you enjoyed this. And if there's any questions, let me know. If not, I want to thank you for being here. I got to run, unfortunately, grab some lunch. And this is something I learned, by the way, the sector rotation. When I became a CMT, I had to study a lot of extra stuff. And this is a kind of an odds enhancer that you can use to help increase your probability of success in the markets. That's really all it's about, is looking for the high probability opportunities and taking advantage of those opportunities. So I want to thank you for being here. And again, hopefully I'll see you in the E-mini think tank very soon. So if there's any questions, again, I'll just wait for a few minutes and see. And if not, again, I want to thank you. Yes, I'll be putting out the SPX cash flow secrets trades today in just a little bit. Be putting those together soon, and I guess about an hour. All right, well, thank you again, everybody. Take care, trade safe, trade well.